This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Wednesday, February the 10th, 2016. I'm Gord Long at GordonTLong.com. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscribers report so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term, risk, and the short term, confidence and sentiment. This month, I'd like to cover a range of topics listed here. First, I would like to talk about market fundamentals, breadth, and obvious market weakness. Second, the underlying liquidity problem. Third, the credit cycle and the soaring increase in global risk arising from this major trend reversal. Fourth, what we expect and where we stand with our longer-term MTOP expectations. We talked throughout 2015 about falling top-line revenue growth. Then in Q3 and Q4 2015, we began talking about falling profit growth. We pointed out continuously how buybacks were hiding reality as EPS growth was actually based mostly on a shrinking denominator. We additionally began pointing out that margins were showing noticeable weakness and cash flow, EBITDA, was falling rather rapidly. We now witness 12-month forward earnings per share, which factors in expected buybacks, is being taken down quickly and significantly. If previous forecast reductions are any indication, then the current rate of reduction is truly alarming. As I will show in a moment, 2016 earnings per share growth estimates have been slashed by 50% just 1 month into the year. The fundamentals are also suggesting falling earnings are in the cards and should be expected. FactSet notes that it is usually the case that analysts predict significant increase in earnings and revenue growth in the second half of the year. In terms of earnings, the estimated declines for Q1 and Q2 2016 are negative 5.3% and negative 0.4%, while the estimated growth rates for Q3 and Q4 2016 are plus 5.5% and 10.7%. In terms of revenues, the estimated declines for Q1, Q2 2016 are negative 0.1% and negative 0.1%, while the estimated growth rates for Q3, Q4 are plus 2.3% and plus 4.5%. These are ridiculous hockey stick predictions that only the very naive and novice could possibly believe. The hard reality is that these forecasts will never materialize, which can be seen in the full year earnings per share forecast and is highlighted in the box shown here. In a single month, full year earnings per share has declined from 4.3% to 2.2%. The comments from CEOs during the latest earnings conference calls are truly alarming. Every indication is that the fall in earnings may be more pronounced than the period which kicked off the 2007 financial crisis. Here are just some typical comments that I've seen. The CEO of Emerson, quote, "We are now basically in our fourth quarter of the recession. I see at least one more quarter, maybe another quarter." Who's talking about being in a recession? He's saying this is a given. Here's the CEO of Cummins Diesel. Quote, "Industry demand for medium and heavy-duty trucks in China decreased by 24% for the full year as the industrial economy has slowed." Cisco, the food producer, here's their CEO. I quote, "We currently believe that deflation headwinds will persist for at least the remainder of the fiscal year. Deflation impacts the P&L. The reality is it's not a great environment because you end up with fewer dollars to pay your expenses with. The Chinese are looking to shut down steel capacity equal to U.S. output. And here's Praxair's CFO talking, and I quote, "Clearly you have a situation of excess capacity across most infrastructures supporting industries like steel, glass, and cement. The Premier recently here announced their goal to take out about 100 to 150 million tons a year capacity. And just to put that in perspective, that's like the entire capacity of the United States." I can go on. They're consistently alarming, and I have some links on the site that would help you follow up on that. The market is only beginning, in my mind, to reflect the realities of what these CEOs are reporting and saying. The financial markets are now being forced to listen because the momentum players are now exiting. I've written a number of articles in the last 60 days on the precarious nature of the markets and the startling lack of breadth. These articles shown here can be found in the commentary section of our website or in the public edition of the Triggers webzine. Basically, about 10 stocks have been holding up the U.S. equity markets. Market breadth deteriorated in Q4 2015, but not the indexes. Index weakness began in January as these 10 stocks began to see selling pressures. What is important for investors to understand is that the rise of index ETFs and mutual funds, which all depend on these 10 stocks, has never accounted for this much of the market before. The rapid emergence of index ETFs accounted for nearly 30% of the trading in the U.S. equity markets last summer. Weakness in these stocks will magnify or even potentially cause flash crashes if they break critical support levels, and that's where we're at right now. This is an untested $1 trillion stock bubble problem that's looming here in front of us. The rolling 3-month asset purchases by the global central banks gives us further insight into another development going on below the surface. Having become addicted to liquidity injections by the central banks in the post-financial crisis period, the liquidity growth decline since the U.S. taper program was implemented is clearly being felt globally, particularly so in the emerging markets. The forced selling by the emerging markets due to negative current account balances and currency pressures has significantly aggravated a very tenuous situation. Richard Duncan at Macro Watch does a stellar and unique job of analyzing global liquidity pressures. His proprietary liquidity gauge showed what we should have expected in 2007-2008 if we had been following it at the time. The question is, if we knew the liquidity levels today, what would we do? Well, here it is. Thanks to Richard, this is his best case projection. He strongly believes that unless the U.S. Federal Reserve immediately takes policy action, the U.S. will be in a recession in 2016. That is, if it isn't already. A big part of the problem of what is a cascading situation is the amount of U.S. dollar-denominated credit to non-banks outside the U.S. and particularly to these emerging market nations. An unprecedented strengthening of the U.S. dollar is making debt payments a major burden for debt holders of weakening emerging market sovereign currencies. The situation is effectively an unexpected sucking sound of liquidity being taken out of the system due to the strengthening U.S. dollar. Leverage and margin is being forced out due to these payments. Additionally, private credit is contracting in the major economic regions of Japan and the Eurozone, while basically stagnant in the UK. After trillions of dollars in bank bailouts, historic central bank liquidity injections, and $8 trillion in deficit spending, private credit in the United States has only managed a paltry $1.5 trillion increase in the 7 years since the financial crisis meltdown. We have a global problem in the growth of private credit. I have discussed previously with you how falling cash flows and EBITDA, coupled with high corporate debt levels, are a central reason for the recent credit cycle reversal. This trend reversal is not about to be reversed, as credit cycle reversals are normally infrequent and can be expected to take years to reverse. Again, it is a process that is about resetting debt to manageable and serviceable levels. It normally forces out the malinvestment created by easy credit. It is extremely worrisome, though, in this particular credit cycle reversal because of the size of debt and malinvestment, leverage outstanding, and the degree of collateral impairment underpinning the debt pyramid. Reduced corporate dividend payments are a sure sign that the credit cycle has reversed, which we are now witnessing. The number of dividend reductions has now far surpassed 2008. It is almost 100 more than at the outset of the Great Recession, a time when the implosion of Lehman caused equity markets to plummet in the later stages of the third quarter. As Bloomberg reports on this fall in dividends, and I quote, "Because of the stigma associated with cutting dividends, management is loath to go down that path unless the need is dire. The trend towards trimmed payouts hasn't let up so far in 2016, especially among companies under stress from soft commodity prices. In recent days, ConocoPhillips slashed its dividend by 66%, and Potash Corporation of Saskatchewan reduced its by 34%. The ratcheting down of payouts to shareholders is a function of weak commodity prices, sluggish growth dampening corporate profits, and a tightening of credit conditions. This combination, and particularly the stringent lending, could exacerbate the carnage already seen this year in financial markets, further dampening economic activity." End of quote. As credit markets shut off the source for economically rational shareholder friendliness, the situation is only going to get worse. We can now expect the market buybacks elixir to finally start slowing. We should expect the unexpected throughout 2016. I thought this nearly 100-year commodity chart of the rolling 10-year annualized percentage returns to be quite enlightening. I marked it up to show a very clear head and shoulders pattern. Though we are near completion of this classic pattern, there's still more to go, and maybe more importantly, it suggests low commodity prices are likely to be with us over the next decade. That is, if a head and shoulders pattern is applicable to a century-long period of data. It does tell us, though, we are in the midst of a major economic event, maybe an unprecedented resetting of economic growth associated with the 19th and 20th century industrial revolution. This is significant. This is unprecedented that we're seeing right here. We are well aware we've had three major financial market waves over the last 15 years. What we often refer to as the dot-com bubble, the housing bubble, and what I'll term as the most recent, the central bankers bubble. Actually, all three were a direct result of central bank policies or failed policies. Each of these peaks, interesting enough, approximates exactly 7.4 years. The third wave might itself be considered consisting of three waves, as shown here. What is important to see is that once again the emerging markets are central to the problem. Debt levels, overexpansion, foreign-denominated debt, all are major issues that are and will have a profound impact to global markets over the next 5 to 8 years. We see the pronounced decay trend in corporate profitability in the emerging markets here. It may get worse with $9 trillion in debt outstanding, needing to be serviced and rolled over. This is a problem. With over $7 trillion of bonds now trading at negative nominal yields, it is telling us that something is seriously wrong and needs correcting. Recessions and depressions are usually the outcome required to do the dirty work of resetting the stage, which political leaders will avoid at all costs, and any policy to try and defer it. A flat and inverted yield curve is usually historically the most prevalent and consistent indicator of coming recessions and this process of realignment and adjustment. We've been watching very closely the triple bottom in the 210 U.S. Treasury yield curve since Q4, maybe even Q3. You've seen this particular chart a number of times. The yield curve has been as flat as it's been since the last recession and clearly shows a triple bottom here. As we prepared the slides for this discussion, we see that the triple bottom has now been decisively broken. We are in fact moving to an inverted yield curve. That is very worrisome to the global markets. Borrowing costs for high-yield companies, which we have also shown previously, continues to rise dramatically from the 2014 lows. There's almost a panic going on here in these charts. Global risk measures are now breaking out quickly. The bottom line from the reversal in the credit cycle is that we are getting signals that it could get very ugly in 2016. We believe our MTOP, which we fashioned a few years ago, is playing out extremely well. We likely have more downside to go before we see a violent counter rally based on likely coordinated and surprising central bank actions. Of course, these actions will fail, but not before wreaking havoc on the bears. We may not get a new higher high shown here. We may not get a double top. We may instead see a standard Fibonacci 61.8% retracement. Time will tell, but don't be caught in a bear trap. Our 200 DMA and our 400 DMA boundary conditions chart served us very well during the 2007-2008 financial crisis. They appear to be serving us well again. Bad things happen when the 200-day moving average crosses the 400-day moving average. It is rare and is almost always followed by a protracted period within the new directional trend direction it establishes. We aren't quite there yet, but we're extremely close. We would expect prices to minimally test the underside of the 400-day moving average as overhead resistance before the long-term top is finally in, likely in Q2, Q3 2016. In conclusion, let me reiterate. I continue to fully expect a Minsky melt-up before all this ends, very badly, in 2016, maybe possibly 2017. Eventually, it will be clear to all that the central bank policies have been an abject failure. The government's policies of financial repression are becoming too heavy-handed as productivity falls, high-paying jobs disappear, and tapped-out consumer demand steadily erodes. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2016 be an outstanding investment year for you and your family. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.